Regional Vice President for Mortgage Alliance in BC, also mortgage broker, and run a team of over 250 mortgage professionals in BC. And we're excited to have you on the session today, take you through how you can utilize the equity to create more wealth.
Thanks, Kevin. So in today's economy, it's near impossible to get ahead financially without employing some level of leverage. Our objective today is not to say that everybody should borrow as much money as possible. Everyone's situation is unique. You should be sure to speak to your financial advisor to determine what is appropriate for you, your family, or your business. If you're looking for a second opinion, Kevin and I are always happy to help. We're going to start with a brief economic update. Then Kevin will walk us through some home equity strategies to consider. And then I will discuss how employing leverage in the equity markets could look. First off, I'm going to start with sharing a quick word from our Bank of Canada Chief, Tiff Macklem.
Require considerable monetary policy support. Our overriding message to Canadians is that the bank will be there to provide monetary stimulus for an extended period to support the recovery and to return inflation to the 2% target. Interest rates are very low and they're going to be there for a long time.
So what does that mean to us as average Canadians? What it means is that the interest rates are going to be very low for a long time, and we should be making financial decisions that will put us in the best position possible given that information. Do I think it's financially prudent that the Bank of Canada keeps interest rates this low and further fuels the housing market and equity markets? Maybe not, but the fact is that it's a reality. Several countries like Japan and many in Europe have had negative rates for quite a while. After the financial market bottom, March 23rd, we have seen a meteoric rise. That was led primarily by Jerome Powell, the US Federal Reserve Chair, announcing the US's fiscal stimulus efforts. So welcome to the debt buffet. Secondly, technology giants, so Amazon, Facebook, Google, Netflix, they've had a meteoric rise during the COVID pandemic. Investors have had to put their money somewhere since mass money printing is going to devalue currencies. Tech companies have done even better during the pandemic than they were doing in the previous normal economy. Hope you had some shares in Zoom, as that's a platform we're using today. They're actually up 600% for the year. Lastly, regarding the economic update, government money and stimulus. So we talked a bit about low interest rates and what the central banks are doing. Justin Trudeau and our new finance minister, Ms. Freeland, they're being quite generous with taxpayer money. It's hard to say how long this will be possible. CERB, CEWS, and other programs have deferred with a pandemic-induced recession. But it's unclear how things are going to play out when these programs will actually end up finishing. So over to you, Kevin.
All right, thank you, Brennan. Let me just share my screen. All right, so yeah, we wanted to really take you through how you can utilize the equity that you've built in your home to better leverage your situation, both if you've compiled debt or just for investment purposes alone. So I always look at debts, you know, there's good debt and there's bad debt. And a lot of people don't really understand what good debt and bad debt is. Some people just don't want to be in debt at all. Which is fine, but you're probably not leveraging your money as good as possible. So good debts are things that where you can loan or lend money to an appreciated asset, right? So I look at good debt, especially, you know, a mortgage being a good debt. Obviously, if you bought a home in Vancouver over the last few years, you have equity in that house. If you bought it in 2016, you probably have double the equity that you had, when you bought it in 2016. So, you look at anything with an appreciated asset as a good debt. I've got probably over $1 million worth of mortgages with investment properties and everything together. And I'm totally fine with it because there's an asset backed by it that is worth, double that amount. So I look at education as a good debt because you're investing in yourself. You're educating yourself to make more money. So that's an appreciating asset. And also, of course, small business loans. So if you're trying to get a business up and running, there's good debt behind that because your business is growing and you're building equity in that as well. Your bad debts are going to be the things that are depreciating, like the credit cards, the cars, and unnecessary purchases. So that's just kind of a general sum. So good debt secured by an asset that has the potential to grow in value, can usually be cleared with profit by the sale of the asset. The cost of interest is outweighed by the increase in the investment. So, we're going to go through this a little bit later, but say that you've taken out and you want to do a leveraged loan for $20,000 and your interest rate on that loan is, 2.25%. And you throw in an investment that's making you 7%, well, you're going to net the difference on that being a good debt. So on the bad debt spectrum, you were looking at an asset that the debt is associated to depreciates in value. So like definitely cars. I know a lot of people like their cars, but there's not many cars that are appreciating in value. As many know. The consumer goods purchased through credit cards and not paid off, these are bad debts. I highly advise using a credit card, and I highly advise paying it off in full monthly if you can. Never carry a balance on your credit card. You're going to actually make money if you use a credit card and pay it off in full in a month. You pretty much have free money for 30 days. So you utilize the money on the credit card and you can set up a lot of your credit cards for automatic full payments each month. Usually these bad debts also have very high interest rates, which are just going to bog you down. So we're going to take you through some steps on how to kind of mitigate those bad debts. So with the bad debts, what can be done to help bad debt? So pay off in full with available cash. Win the lottery, which obviously is a low percentage chance of doing. But if you do, pay off your debts. Increase your monthly payments on those debts if possible. So especially those credit cards, you want to pay off as much as possible on a monthly basis, as the credit card interest rate at 18-19%. It's going to take you off forever. It's going to take you forever to pay that off on a monthly basis on the minimum payment. So I couldn't stress that more, to pay that off in full whenever possible. Consolidation loans have been a lot more popular these days with one monthly payment. So you can actually get personal loans done up, which we have access to as well. It's not the number one choice for me, but you can actually get a consolidation loan to consolidate all those debts into one. So say you have a credit card, a car payment, maybe a line of credit or something you want to put all onto one with one payment and an amortization schedule behind it. But we're looking at like a 6 or 7% on that. So it makes sense if you've got credit cards, you want to kind of bulk those together. Maybe not so much if it's a car loan, because it's probably going to be in around that same interest rate. And then sometimes, I've done this in the past with my own dad, actually, is leveraging his line of credit to access funds for a consolidation loan. So, or investment even in that case. So, a line of credit, especially if it's a home equity line of credit backed by your home, the interest rate's quite low on it right now. I think we're probably like prime plus 0.5 is where we're at with the HELOC. So we're in around the 2.6 range. So that can be very good way of doing it, which I'll showcase here a little bit later. So home equity is definitely king for riding out bad debts. Like I say, if you bought your house, in 2016, you're gonna have lots of equity in your house, or your condo, or your townhome, because of the appreciation that we've seen since then. Even if you bought it like 2 or 3 years ago, you're still gonna have some equity in there, depending on how much down payment you put down. It's secured by an appreciating asset, which is ideal, because that money just keeps growing in your home, and you might as well leverage that money in there because it's not doing any work for you right now. So Increase available cash flow with lower total monthly payments. Obviously, you know, you're going to have lower monthly payments. So, you know, once you consolidate all that, you're going to have more available cash to do investments or, you know, buy other things or just, you know, lifestyle in general, having more available cash on hand. So how to access your home equity. So there's a few ways of doing this. The ideal way is obviously refinancing your principal residence. That's one of the easiest ways of doing that. You can refinance an investment property mortgage. So if you have an investment property already, you might as well take out the money there and utilize it elsewhere, whether it's, you know, another investment or buying another home. It's a lot of clients. I've got a lot of clients that definitely utilize that. So they'll pull out $100,000 from an investment property, use that $100,000 as a down payment on the next property, which can obviously be lucrative if you're going down the investment property rank. So applying for a second mortgage, not the most ideal, because second mortgages are usually on a higher interest rate. But they are available, and you know, in a second mortgage, we're usually starting about 5 or 6%, but most likely in kind of that 8-9% range. So it's not most ideal, but it's still available if needed. And applying for, like, the most ideal is applying for a home equity line of credit. We've got some lenders, Scotiabank, Manulife, where you can actually have a home equity line of credit. The Manulife one is actually really popular because you can actually centralize all your checking account. You can do your credit card payments through your home and actually pay off your mortgage faster because all your income's going into that same account. So if you wanted more information after this session on that, I'd be happy to take you through it. But I actually have that on my own home. And the greatest thing about it is liquid. So when I need cash, and if I want to invest, if Brandon comes to me and says, hey, Kev, we've got a great deal, I think we should invest over here, then I can just reach out and just pull out, you know, the 10, 20, 30 grand if I wanted to, from there at, you know, 2.6% interest, with the investment coming back and yielding me, you know, 7-8% interest. So that's a very, very popular route when we're going down this road of refinancing and pulling out equity. If you pull out equity in a full mortgage, the biggest difference is that you're pulling out all the funds at once. So when you're pulling out all the funds at once, you're getting charged interest rate at once. So it's great if you're just doing that consolidation loan, but if you want to have that liquid cash available, the line of credit's great because you can just pull it out when you want it. And the great thing about the Manulife one, so when you're doing investments with that line of credit, you can actually track that investment on your Manulife account. So you can do sub accounts. So you can say, hey, I'm putting this $30,000 in investment, and then you can actually use the interest on that investment to write off on your income taxes. So a very, very prevalent way of, and very savvy way of investment and going down that route. So what's needed as part of that refinance, the application process, I'm sure many of you have been through this process. If not, it might be a little bit new to you, but you know, when you're doing this process, the lender is really, they really need to like find out who you are, what your background is. So, you know, you're going to be giving your personal information, your work, your assets, your liabilities. We're going to pull a credit bureau on you to see how your credit score is. We're going to want to see credit scores over 680, more or less 700 now these days, with clients where there are options in lower credit. So we can go to other lenders like B lenders to get access to money if you need it, and it still makes sense, right? Because at the end of the day, you don't want to be in that 18th percentile with a credit card. So there are, if you do have damaged credit, we can help you out there. And then we get to a point where the credit's good, and then we refinance it again and put it in a product. So lots of options there down the line. So you should, if you have equity, you're gonna have an option to better yourself. Employment docs, so employment letters. So you would get an employment letter from you know, your employer stating your tenure, stating, you know, the salary, your job title, and it's signed off by the employer. NOA, so if you're, you know, business for self, we're going to be looking at obviously business income coming in, your NOAs, how much you're paying yourself, T4s, if you're employed, and obviously recent pay stubs. A property appraisal in most cases is needed, especially if you're putting 20% down on your property, or it's a refinance in a conventional manner without insurance. Property appraisal, they come into your home and review it, compare it to other properties that have sold in the area, and give you a value, which the lender utilizes to calculate how much you can actually borrow from that property. And then obviously a lawyer to close the transaction in all cases. So that's the typical process for that. So debt refinance example, I just want to take you quickly through that. So just a house, $750,000, probably won't get you a house these days, maybe in Chilliwack or Mission, depths of Maple Ridge. But if you have the market value at $750,000, you're going to have access to 80% of that, which is $600,000. So if you owe $350,000 on it, you're going to have available equity of $250,000. With that remaining equity, it has to stay within the house because you can only refinance up to 80% now. And that rule has been in place probably for a good 7 years now, whereas we used to be able to refinance up to 95% of the property. And the only time you can actually refinance up to 95% of the property is when you're going through a separation. So if you're separating from your spouse, you can actually refinance your property to do the buyout for your spouse in that property. So that is the only time where you're allowed to use the 95% to pull out the equity in that home. So good to know there. Obviously, it's not the best, but if you are going through the unfortunate situation of a separation, that is an option for you. So I just wanted to take you through kind of how a before and after would look in a refinance. So, you look at the before, we've got credit cards, say $9,000 owing at 19% interest. That's a minimum monthly payment of $360. A car loan at $25,000, 9%, that's $506. Student loan, $20,000, 5%, that's $377. Your mortgage at $350,000 at, say you're at 3% interest rate, that's a monthly payment of $1,656. So the total owing is $404 at a monthly payment of $2,950. Taking it to the after side, we are looking at, your credit card cleared, your car loan cleared, your student loan cleared, or any other loan that you had. And then you would, in this case, potentially paying a mortgage penalty, call it like a 3-month interest penalty. It may be an interest rate differential penalty. Legal fees, $600, and your new mortgage being, so you can look at the mortgage, and yes, you're going to owe a little bit more on the mortgage, but look at the cash flow savings. It's like $1,065 is the savings in there. So you're going from a monthly payment of $2,950 to $1,885, and you ask yourself, what could I do with an extra $1,000 a month for cash flow purposes? And obviously with COVID happening and reduction in hours and different things like that, that could make a difference for you. It's interesting. I made this document probably about 2.5 months ago now, and I've got an interest rate of 2.69. And we're down, like insured rates right now are down to 1.85, which is the lowest I've ever seen on a fixed rate. It's a really interesting market right now, but you can really take advantage of those low interest rates. And we've been putting a lot of clients that were in a 3%, a 3.2%, 2.8%, and moving them over to a lower interest rate. And the savings that you have on that interest is actually going to outweigh that penalty. So a lot of times it makes a lot of sense to refinance and just look at the interest rates as they are right now. And a lot of times they net a lower monthly payment for you as well. So there's definitely, you really want to, whether you have a broker or you need to utilize a broker, we have a team of brokers, you can contact myself, but like reach out to your broker, I would say, and just, and do like a checkup with them, because if you do a mortgage checkup, you might find that there's thousands of dollars sitting there for savings. So I would highly advise doing that checkup, whether it's myself or my team or your own specific broker. I'd say like reach out to them, because there may be a huge savings there for you. So this is just kind of like a consolidation example, but another example would be just, if you do have that equity in there and you want to refinance into like that Manulife type product where you have available cash flow, it's highly advised. Like I was advising clients to do it because we were actually expecting a recession this year. We didn't expect it to be because of COVID, but we were expecting, Benjamin Tal was predicting a recession the start of the Q2 of this year, which actually happened, but was not for the reasons that he was speculating. So, what I was trying to get my clients into was liquid cash. So having available liquid cash. So think about, like, if you refinanced in January this year and then COVID happens and you have all this extra cash available to you, you call up Brendan and say, because the market's down, so you're getting everything at a discount at that point. If you don't have available cash, you can't invest. You don't have the available cash to invest, in the market, and you could make huge gains, in the initial stages there. So it's always good to have that available cash within your home. I would highly advise, adding a line of credit to your home, or just like really do that checkup and ask your broker to see if it makes sense. Because, when these investments come up, it's always nicer to just have access to the cash, right? Because you can just pull it out right away and then you can sublet it on your account. Whereas if the investment opportunity comes up and you have to go through the refinance process for that opportunity, that's going to take a good 4 weeks to get done. Maybe two at the shortest, but I think it's definitely more of a savvy move if you can get a line of credit attached to your mortgage product. And there are lenders obviously that do utilize that, and I find myself using the Manulife one because of the flexibility the most. So that's really just to recap kind of what we've gone through. Know the difference between good debt and bad debt. We want to make sure the bad debt's cleared out in any way possible. If you have a car loan, try and, I would look at sinking it into your mortgage, because your interest rate's just going to be that much better, and it's going to free up cash flow for you. Find solutions to eliminate that bad debt. Obviously, that HELOC is a great solution. There's other loans that you can get, consolidation loans, but I would just highly advise to do a mortgage checkup and a full review, with your financial planner and your mortgage broker. Use credit cards, but pay them off in full monthly, because you're actually going to make money, because a lot of them have cash back features. The travel cards probably aren't the greatest these days because of what's going on, but the cash back cards, we have one at Mortgage Alliance, so we get 2% cash back on all groceries, and then we have a 3% cash back in the initial stages for all home renovation categories. So that's a great card as well. I utilize that one. And then contact your trusted mortgage professional and financial advisor to evaluate your unique situation. I can't stress that enough. Leverage your people. Like, honestly, we get paid by the banks on the mortgage broker side. So, you're utilizing us for free. The only time we're charging fees is if we're really bad credit. We have to charge a fee because those lenders actually don't pay us out on the mortgages. So I will then pass it off to Brendan. My moment is done here.
Awesome, Kevin. Thank you very much. And Kevin is extremely knowledgeable. He's helped quite a few of my clients who were in a bind with some of their mortgage financing, especially those that have property in Alberta. So thanks so much for sharing, Kevin. Okay, so we're going to switch gears a little bit here. Still talking about leverage, but now we're going to speak about leverage in the equity markets. Now, once again, I'll stress this isn't a strategy for everybody. There are a few factors that you'll want to consider if you are going to employ something like this. So we just talked about leveraging into real estate and how that can help you build wealth. But leveraging, all that really means is borrowing someone else's money to do something with it. Could be starting a business, could be buying a home, could be buying stocks. By borrowing a lump sum of money today and investing it for the long term, it allows you to take advantage of time and compounding. And I'm going to run you through some examples to show you how that is the case. The whole premise is that over the long run, you're going to have much more money and a higher net worth by borrowing a lump sum up front and investing it versus simply saving on a monthly basis. So the example we're going to look at here is of a leverage investment of $125,000 versus simply saving $416 a month. The people that are going to want to look at leverage are those that have limited RRSP and TFSA contribution room. They're going to want to enhance the retirement income with non-registered money. They care about leveraging the tax system to build their wealth. Since people are retiring earlier and living longer, they need more money for retirement than ever before. As an example, 30-year-olds with a retirement goal of 60 and a life expectancy of 85, if they wanted $40,000 a year in today's dollars, they're going to need to have saved $1.5 million. And that seems daunting, but if you start planning early, you'll have more flexibility down the road. The type of people that tend to leverage into equities are not novice investors. They have had experience investing in the past, and they have to be comfortable with market volatility. They need to be able to withstand the fluctuations of the market. Business owners and entrepreneurs are typically suitable for leveraging because they're used to borrowing to invest in their business. They understand cash flow requirements and the necessity of maintaining adequate financial reserves for emergencies. And I know I missed a question, but we'll get to that one at the end. I know Kevin's monitoring them now. A typical investor that we'd see do leverage investments would be someone who can withstand volatility, someone that has a financial plan. It's never the first strategy that I'll talk about with a client. It's typically after I've built some rapport and understand their ability to withstand long-term planning strategies. Their income should be stable and protected. So they should have some level of disability coverage. And ideally, they work in an industry that's not very risky from losing their work. For example, if someone was working in Alberta in the oil fields, that might not be the best person for a strategy like this because they have a high chance of losing their job due to the cyclicality of their industry. However, the technology industry has been quite resilient, and I would argue likely will into the future, which allows folks in that industry to perhaps take on more leverage and be comfortable that they're not going to lose their jobs. At the end of the day, clients should always be able to factor in the what ifs before they make a decision like this, because long-term leveraging, it is a strategy that involves a high level of risk. So we talked a bit about benefits, but you can likely deduct the interest that you're paying on an investment loan against your income. This becomes extremely beneficial as you start earning six figures and your tax rates start to go up. You will be able to maximize your portfolio growth, recognizing that you also could magnify your losses if you were to sell when the market was down. And we are in a very low interest rate environment, and it sounds as though we will be for a long time. And so that makes the strategy even more effective. Risks, market risk. If you had bought in February and sold in March, you might be down 30% or 25%. So you need to recognize that there are ups and downs to the market, and you need to be okay with that. Interest rates are very low now, but they may not be low forever. It sounds like they will based on what central bankers are saying, but we need to factor in the what ifs. What if interest rates go up 1 or 2%? How is that going to impact cash flow? And are you going to be okay? And then, of course, cash flow risk. If you lost your job, would you have enough cash reserves to weather the storm until you were able to earn an income again? So like most of the strategies that Kevin and I are speaking about today, you really do want to leverage a financial planner to develop an overall financial plan, determine if the suitability of the strategy is right for you. Kevin and myself, we're always happy to help, but if you have a trusted professional, do leverage their expertise. With this particular strategy, you do want to have a long-term focus. Typically, there are equity-based investments in mutual funds or segregated funds for growth potential and tax advantages. Markets are going to go up and down, but if you're doing a long-term strategy like this, you should stick to the program and not worry about the headlines. So just some specifics about these type of programs. If you can do the borrowing through your home equity line through Kevin. If you don't have a home, it is possible to do the strategy if you have a good credit and solid income. There are no margin calls with these programs if you do it through me, which means if markets are down, the bank's never going to call you and say, hey, your market value is down, we need you to top this up, which is a huge factor when thinking about leveraging. if you have a Quest Trade or an independent brokerage account, they'll typically offer you money at them on margin. But if you make a wrong investment, they're definitely going to be calling you or seeking creditors after you if you can't pay that back. Yeah, so we'll go through a quick example here. If we were to look at just investing $5,000 a year into an RRSP versus some combination with leverage, what does that look like from a numbers perspective and a nuts and bolts perspective? For this example, we're going to look at a 35% marginal tax rate, which is someone earning slightly over $100,000 a year. We're looking at an 8% annual return on investment, which is feasible. And I actually have the interest rate listed here at 4%. We're actually somewhere in the neighborhood of 2.5 right now. But just to show you that the math still works, even at 4%, I think it's quite interesting to see. So person one, $5,000 a year into an RRSP. In about 25 years, that's going to grow to around $388,000. Of course, it's never a straight line like that, but this is just an example. Person two is going to invest $2,500 per year into an RRSP, and they're going to pay $2,500 per year in interest on an investment loan. After 25 years, that's going to end up being about $224,000 in the RRSP and $428,000 in the non-registered plan. And now option three, if that individual was to invest $5,000 a year paying interest on an investment loan, that would be approximately $734,000 in non-registered investments at the end of that period of time. So when we compare these, we'll say, okay, well, leverage actually ends up after tax offering the greatest amount of wealth. However, that also is the most risky strategy. So typically what I will say is, well, if an investor fits the profile for a strategy like this, it doesn't mean they stop investing their RRSP or they stop investing their TFSA, but it's typically a combination of these strategies in order to balance the growth of their net worth and the risk they're comfortable taking on. So even though the combo here of RRSP and non-registered investment loan is less than leverage, I probably would recommend that situation more so than I would the other way around. So I think we have a couple questions. I know I missed one earlier, and I'll start with that. So the question is, Kevin, if you don't mind answering this one, to qualify for financing, do we still need to qualify using the mortgage stress test? And if so, what is the added percentage rate now? And also, what is a closed 5-year rate for a mortgage rate now?
Yeah, so it's now actually called the benchmark rate. So we use the benchmark rate for qualifying, which is actually at 4.79. It used to be contract plus 2, but everything's kind of moved into the benchmark rate. So we're utilizing that. The only way you get around from that is some credit unions like Blue Shore Financial, they actually will still use the contract rate. So there are some options out in the industry in the credit union land that will use the contract rate if we need it. Unfortunately, the interest rates in those situations, because they're using contract, they take a bit of a higher risk profile to it. So you're going to be paying a higher interest rate for that. So we don't like to utilize it unless it's needed. And most clients are still qualifying in the benchmark rate. We haven't seen a huge issue, hindrance to it. So it's been quite good on that front. And then the 5-year closed fixed rate, so there's kind of two categories now. So there's insured, so CMHC insured mortgages, we're looking at kind of a 1.85. I've seen as low as 1.79. They'll kind of come in through different specials on a 5-year fix, which is just crazy to me. And then a conventional type mortgage where there isn't insurance, or if it's insurable. So there's a new category in there called insurable. So anything under $1 million in purchase price is still insurable, which is going to get you, depending on the loan to value. So the lower the loan to value, it's going to get you closer to kind of that 1.89, 1.9 range. But as soon as the insurance is gone, the lender looks at that, unfortunately, as a riskier play. And you're going to be kind of in that 2.15 right now, which is still obviously really, really good. So when we're refinancing, we're mostly in kind of that, because we're usually in the conventional range and uninsurable. meaning that it's over $1 million in value. As soon as it goes over $1 million in value, it's uninsurable. So that's just the kind of the general rule there, which would be in that kind of 215 range. So hopefully that helps and answers your question there.
Awesome, Kevin. Thank you. Yeah, I guess a question that I have for you, Kevin, is you've bought quite a bit of real estate in the Lower Mainland. Are you, for people that already have a principal residence, do you think now is a good time to maybe buy a second property, or do you think there's going to be more opportunities to come? I know you don't have a crystal ball, but
yeah, I don't have a crystal ball, but I see the spring market next year being really busy, but obviously we don't really know what's going to happen with COVID here. So people are a little bit cautious, but you know what? Like, I have never seen a rebound like this before. Like, we were literally like done for a month, and then all of a sudden everybody wanted to buy houses again. So we took a very small blip in the market, but everything seems to be back to normal. And as long as we don't close everything down again, I think we're going to be healthy. And as soon as that, obviously the vaccine comes into play, that's going to change the game as well. So I look at the spring market. I'm very bullish in the spring market right now. So if you're looking at buying a property, I'd say do it in the fall, do it in the winter. Because once that spring market hits, it's just going to skyrocket. So I think you want to buy when people are a little like hesitant. And right now I kind of feel like we're getting into the realm because people are going back to school and they don't know what's going to happen. And I would always want to buy in that realm because there's going to be less buyers out there. So less competition, things are going up. There's not multiple offers. It's just way less stressful way to buy. Because I've been in the situation when I bought in 2016, one of my properties, we had to go subject free in that offer. And luckily, because of my role, and I was able to do it, but not everybody has that comfort level, right? And you could get stuck with the deposit. So, I would be, bullish right now, especially where rates are on buying an investment property. And if you've got enough equity in your home and we can make the numbers work, we can pull out equity from that home. You can then leverage that equity to buy your new property, right? So, I would say right now that's definitely something you want to discuss with your broker right now and your realtor.
No, it's great advice, Kevin, and I definitely agree. I've seen clients go into those situations where there are multiple offers and they have to go subject free, and most people aren't comfortable because it's pretty scary to have to put down a $70,000 deposit that you could potentially lose.
100%. And how about you, Brennan? Like, what do you see going on in the general market right now? Do you kind of feel the same thing with?
Are you talking like stock market?
Like, it's rebounded. Yeah, stock market. It's rebounded since obviously COVID first hit. So I know when you sent me my portfolio, we were back up again. So that was nice. But what do you kind of see in the fall here?
Yeah, I think that all the money that's getting printed has to go somewhere. So the money is going to go into hard assets like real estate, and it will go into stocks. There's a question of, is gold the place to be? Is China the place to be? Is the U.S. equity market the place to be? I'm still a firm believer in diversification, but for those saving on a monthly basis, they should continue. Those of my clients that did leverage into equities in March, April, their portfolios are looking pretty good. Over the next few months, I do think we'll see more volatility. With the November election around the corner, that usually breeds some level of uncertainty, especially as we've got a president who tends to focus on the stock market. If he doesn't win, stock market will probably go down. If he does win, I still think there's opportunity for it to go down because a lot of his policies have, although inflated the market, it does still feel as though it was a bit of a adrenaline pump to the market.
Yeah.
It's already late in the cycle.
And I think that's why Benjamin Tao was, predicting that recession, back, like when we actually did have a bit of a recession here, but for that reason alone, right? So
you can't just continue to have growth spurred by debt, although it appears as though our central bankers are pushing to have that happen as much as possible. So
Yeah.
It all comes down to, don't over leverage, build enough leverage into your portfolio, use your tax shelters, but everyone's situation is different. Kevin, I did get a question that came in. Actually, this is probably more for me. They asked to see a graph on leverage investing. They recall seeing 2,500 of interest payments per year, but didn't see the principal payment taken into consideration. It's a good question. So if you look at the graph here, it is definitely just showing, this is net after tax. So if you see at the bottom your net after tax capital, this is after the loan is paid off. So you'll see early on, there's actually not very much, but it grows exponentially. And if we look at this graph here where it shows the leverage amount, this is the net amount, and after taxes, so paying capital gains taxes at 35% marginal tax rate, this is the actual net money in someone's account, which they could use to buy more property or use to fill out their TFSA or RRSP if they haven't already, start a business. The wealthiest people in our economy and in the world, they know how leverage works, and they're very leveraged. And so it's not a question of if you should leverage, it's just a question of to what extent you should be leveraged throughout your lifetime, given your goals, objectives, and risk tolerance.
100%. And, you can leverage into an investment property is no different really, right? It's, you're leveraging one home to buy another home. That's the leveraged investment as well. So it's nice to have that balance, with the stock market, with your real estate portfolio, to really have that, comprehensive balance. There's another question that came in about alternative options for people who don't have mortgages or primary residence, but have a good credit score and good income. Could dive a bit deeper in what type of loans that you have access to for that?
Yeah, so through National Bank, there is the ability to leverage into equity markets. Once again, it's not a strategy that I would recommend someone starts with, but if I was having a conversation with a client, I would make sure that they have stable income, make sure that they have built up other assets, so say RRSP, TFSA. And in a situation like that, there could be up to $100,000 that they could borrow fairly easily if they have good credit and they check all those other boxes.
And what's the interest rate traditionally on those, Brandon?
Prime plus a quarter. Okay,
that's not too bad.
Yeah, it's decent. You could definitely get better from a mortgage loan. So at the end of the day, I always say talk to your mortgage broker first if you have the ability to do that. But for those that perhaps don't have that as an option, borrowing from someone like a national bank, it's not a bad program. The banks don't offer this strategy. It's typically only independent investment planners. Good question. Okay, let's see. Do we have it all? I think we've got it all. That's all the questions. Kevin, any final word from you, my friend?
No, just if you want to reach out to me, I don't know if we had our contact information at the start there, but you can hit me up on LinkedIn. Use the messenger service on LinkedIn. Direct message me, and I'd be happy to help or lead you to another one of our brokers on the team. I would just, if you're going to take away anything from this, utilize your professionals. Yes, we make money off these mortgages, but at the end of the day, we get the most gratification when we can help our clients out. We hate to see clients pay bad debt. We want to see them in good debt. We want to see them financially successful, and we're here to help during that process. And it's great that we get paid for it because it's extra rewarding that way. So you can make a career out of it and help clients at the same time. And we're always going to look out for your best interest. That's our job, and that's how we get referrals. So I want to thank you for coming on the call today. This will be recorded if you want to rewatch it. And feel free to hit me up if you need or have any more questions.
Beautiful. Thanks, Kevin. And I'll echo that. I'll be sending out the recording to those who weren't able to join. If you were here and do want the recording, please just let Kevin or I know, and we'll be sure to share. Lastly, if you did find the information useful today, please do share your feedback. This is the first time we've used this live function through LinkedIn, and we'll maybe looking to do more of these sessions in the future, provided we get good feedback from today. Stay safe, everyone, and hope you can prosper through this pandemic.
Awesome. Thanks, everybody.